I'm Kyle with Fundamentals of Finance, and today I'm going to dispel a common myth about mutual fund investing, that lower fees are always better. At the end, I'll go through what I consider to be some of the highest quality funds out there and show you why I prefer them over some popular funds with lower costs. I think the myth that lower cost is always better stems from 2 points. First, the rise of passive investing in the past few decades and the marketing effort that's gone along with it have intentionally and successfully spread this myth. Why? Well, since passive managers just simply track an index, they tend to have lower fees than active managers. Active managers try to beat the index, which often might involve analysts and portfolio managers traveling all around the world to meet with company management teams and combining decades of experience with deep research in order to get an edge. Since all passive funds try to do is copy what's in the index, and that's a lot less work, they can charge lower fees. Since lower fees are their biggest advantage, they push the idea that lower fees are all that really matters, but they're not. Second, I think this idea is simply supported by the fact that all else equal, lower fees actually are always better. But the problem is that all else isn't equal. You can think of this like anything else in life, but with a little wrinkle at the end. If you could get the same TV for $500 or $1,000, you'd always want to go with the lower price, right? Of course. And sometimes there are deals to be found, but usually $1,000 would buy you a better TV than $500 would. You get what you pay for. Mutual funds are similar, except that the future is uncertain. If one TV is bigger than another today, and that's what you're paying more for, you know it's always going to be bigger. That's a guarantee. But future investment results are not guaranteed. Even if you look backward and one fund did better than another, that doesn't mean it's going to happen again. So fees are an important component to consider because they are directly subtracted from investment results, but they're not everything. To help explain how fees work, let's consider an example with two hypothetical mutual funds. If both funds own exactly the same stocks and those stocks go up an average of 10%, investors in a fund with a 1% expense ratio would earn 9%. If another fund held the same stocks but only had a 0.5% expense ratio, investors in that fund would have earned 9.5%. So fees are very important, but that kind of analysis is really only useful between two investments that have nearly identical holdings, like say two index funds or ETFs that track the same index. If you're comparing an active and a passive manager or two different active managers, they won't have the same holdings. And since we don't know how either one's holdings will do in the future, expenses are one of the few reliable predictors. We know if one fund has a 0.5% higher expense ratio than another, its investments have to do 0.5% better just for you to break even. So low costs do matter, but just like not all TVs are the same, not all mutual funds are the same either. It is true that the average mutual fund does not consistently beat the benchmark. But who said you have to pick the average? Can the average person dunk a basketball?
I believe I can fly.
No, but that doesn't mean that no one can dunk a basketball. I plan to do a ton of videos going deeper on mutual fund selection and active versus passive in the future. But for now, let me leave you with a few examples to show you how lower costs are not always better. There are a few companies I could do this with, but for today, we'll use MFS, which I would consider to be one of the highest quality investment managers out there. What you're looking at here is the percentage of time that their actively managed equity funds beat their benchmarks over all rolling 10-year periods that ended in the past 10 years. So the 10-year period that ended December 31st, 2011, then the 10-year period that ended January 31st, 2012, then February 2012, March 2012, so forth and so on, all the way until December 31st, 2021. And remember, these results are against their benchmarks, and many lower cost passive funds just try to track those same benchmarks, but with a small fee taken out. So their results tend to be very close, but slightly worse than the benchmark. Not all active managers beat their benchmarks, but MFS funds typically do. Almost all of them and almost all the time in 10-year periods. In fact, overall, you can see in the upper right that on average, they were successful 82% of the time by an average of 1.1% per year. What does that mean in dollar terms? Well, a $10,000 investment that earned 10% a year would be worth $25,937 in 10 years. If you instead earned 11.1% per year, it'll be worth $28,651 in 10 years, or about $2,700 more on your initial $10,000 investment. That's real money. So 1.1% may not sound like a lot, but compounding interest is the eighth wonder of the world, and after 10 years, it can really add up. To get to some specific comparisons, I'll quote the expense ratios of the iShares, since that's what this page is showing. Starting at the top, MFS International Intrinsic Value Fund is benchmarked to the MSCI ACWI ex-USA. The largest and cheapest passive fund that tracks that benchmark is Fidelity Global ex-US Index, which costs 6 basis points or 0.06% per year. You could also go with options that track very similar benchmarks, like Vanguard Developed Markets Index, iShares Core MSCI EFA ETF, and Vanguard Total International Stock Index, all for less than 10 basis points per year. MFS International Intrinsic Value Fund costs 72 basis points per year on the iShares, or 97 basis points per year for the A shares. But even after taking out those expenses, it has consistently beaten all those benchmarks. And remember, the passive funds that track them have very similar, but generally worse results than those same benchmarks. There are other international funds, MFS International Diversification, MFS International Equity, MFS International Growth Equity, and MFS Research International have also had high rates of success against similar benchmarks, even after subtracting their expenses. I would happily invest in any of those funds over the cheaper, passive counterparts that I mentioned. It's a similar story with their US funds. MFS Core Equity has had a 99% success ratio against its benchmark, the Russell 3000 Index, even though it costs 68 basis points on the iShares. I would happily take that over the iShares Russell 3000 ETF, which only costs 20 basis points. I'd take MFS Research Fund and Massachusetts Investors Trust over cheaper funds benchmarked to the S&P 500 like the SPDR S&P 500 ETF, the Fidelity 500 Index Fund, and the many others out there. And I'd take MFS Value Fund and MFS Growth Fund over their passive counterparts like the iShares Russell 1000 Value and Growth ETFs and the Vanguard Value and Growth Index Funds. Same goes for global. The thing you have to know about investing is that nothing is cut and dry. Nothing is guaranteed. There are no universal truths. All we can do is make decisions that give us the best possible odds of achieving our desired outcome. Do lower expenses help lead to better results, all else equal? Yes. But as we've discussed, all else is not equal. And just because the average active manager does not consistently beat its benchmark, it does not mean that none of them do. MFS, which we've highlighted here, and American funds both have fairly broad lineups of options that have had really high rates of success over time against their passive benchmarks, and by extension, passive funds that track them. There's no guarantee that will happen in the future, but unlike simply looking at the last 3 or 5 or 10-year period, I'm talking about rolling periods over decades, hundreds of different periods. When you can look across an entire fund family and see a long track record of consistent success across the board in lots of different kinds of funds and lots of different market environments, there's a pretty good chance it wasn't luck. There are inherent advantages that give certain funds or fund families an edge over the competition and allow them to separate themselves from the average. Low costs are one, but there are also many others that I'll dive into in future videos. But needless to say, I believe that MFS has some of those advantages. So while there's no guarantee that their past success will persist in the future, based on my best judgment, as long as those special advantages remain in place, I'd feel like the odds of success are higher going forward with these MFS funds than they would be with the lower cost passive competitors. And if you really want to learn how to invest, check out my free webinar below called the 9 Habits of Successful Investors. The link is in the description. Thank you for watching, and I will see you in the next video.